Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, earnings season continues apace, and today we're taking a look at the results for the first financial quarter of 2021 for two Canadian-based, or Canadian-owned rather, but regionally operating banks, and we're talking about Scotia Bank, Trinidad and Tobago, and FirstCaribbean International. Now, a lot has taken place. There are some similar trends, but both companies would have reported slightly contrasting earnings results. So let's turn quickly to Scotia Bank, and for the first financial quarter ended January 2021, Scotia Bank would have reported an earnings per share figure of 83 cents, which was a nice moderate 2.2% increase from the 81 cents reported in the prior comparable period. Now, that being said, net interest income was down around 6.5%. From 339 to 317 million, with total revenues declining overall by 7.3% from 476 to 441 odd million. Non-interest expenses did in fact decrease by around 5% from 210 to 200 million, and there was a quite sharp decrease in net impairment losses on financial assets, signaling some improvement over the corresponding periods of improvement in credit quality or perceived credit quality, and we see that net impairment losses would have decreased from 52 to 22.8 million, or roughly a 55 to 56% decrease, leading to an increase in net income from 142 to 146 million. The big story, however, has been that revenues across all of its operating segments have been lower. We can see in the traditional banking segment with respect to net interest income, there was that 6.5% decline from the first quarter of 2020 to the first quarter, financial quarter, that is, of 2021, of around 6.5% from 339 to 317 million. And in terms of other income, there was also a decline as well, of roughly 9.5% from 137 to 124 million dollars over the corresponding periods. And that really bucks the trend that would have been experienced of modest revenue growth over the past prior couple of first quarter periods. We can see it was 2.1% growth in first quarter 2019, 4.8% in first quarter of 2020, now leading to that overall decline of 7.3% in the comparable period of the first quarter of 2021. When we take a look at how investors are valuing Scotiabank stock relative to the banking sector, we can see that in general, the banking sector stocks, when measured by the price to earnings ratio, have been becoming a little bit more expensive on average from that 2019 level, where they were roughly a 14.6 times PE. They've climbed since around 22.5 times in terms of a price earnings multiple, meaning that for every dollar of earnings generated, investors are paying a higher and higher price for each dollar of earnings. And in similar fashion, we could see that Scotiabank would have experienced a similar trend, moving from that 16 to 16.5 times level in 2019 to 19.7 times at the end of 2020. Moderating a bit to 18.6 times in its current PE multiple, but it still goes to show that investors are still paying a little bit more for each dollar of earnings generated by not just Scotia, but every bank on the banking sector. So at a price of $55.28, Scotiabank is trading at that price earnings ratio of 18.6 times compared to the 22.5 times average of the banking sector. So below average, which is a good thing in this case in terms of valuations, and offers a still quite compelling dividend yield of 4.1% in the current low interest rate environment, and is well above the banking sector average of 2.3%. So on the basis of those fair valuations, consistent dividend payments, but that lingering economic uncertainty, as the economy opens back up, particularly Trinidad and Tobago, Bourse is going to maintain a neutral rating on Scotia for the time being. Turning quickly to FirstCaribbean International, well, a little bit less positive news. Earnings per share by the bank for the first quarter of 2021 fell 40%, from 21 cents in the prior comparable period to that 13 cents per share. Total revenues were down 14.4% from just over 1 billion TT equivalent to 913 million TT equivalent, and operating expenses declined by a less than proportionate 5.9%. Overall, there was an increase in credit cost expenses from 29.2 million TT equivalent to 48.8, leading to that net income attributable to shareholders declining from 336.9 to just around 201.9 million TT equivalent. That's that 40% decline we would have seen. In similar fashion, we see that revenues would have fallen as well for FirstCaribbean. And when we take a look at their traditional net interest income, we can see that there was a quite significant fall from 706 to that $623 million figure. So roughly a 9.5% to 10% decrease. As well as in operating income, there was also a significant decrease from 361 to 290 million TT equivalent. When we take a look at FCI and how it's priced relative to the banking sector, well, currently on a trailing basis, it does offer a negative earnings per share figure, so that's a fairly useless comparable or multiple at this point in time. So we take a look at another metric, the market to book figure, and in the green, in that green column, we can see that FCI's market to book figure has been climbing somewhat, but overall has been relatively stable, although modestly increasing at around that 1.6 time market to book level. And that has really been because of a significant adjustment to its price to keep its valuations relatively consistent on a market to book basis. And of course, it's trading at a certain discount relative to the banking sector average of around that 2.09 times. So offering some relative value to investors, but I mean, on an absolute basis, if you were holding the stock, it would have been quite a painful time from 2017 to now, falling from that $9.15 price on the Trinidad and Tobago Stock Exchange to $6.95. So at the price of $6.95, FCI is trading at, well, again, that market to book ratio of 1.6 times relative to the banking sector average of 2.09 times. And despite not paying dividends for the last two normal periods, it still offers a trailing dividend yield of 2.4%, which compares relatively favorably to the banking sector average of 2.3%. Now, as economies open up and vaccination campaigns go on apace, that's one positive driver, but still there is the prospect of a very sluggish regional economic recovery. And on that basis, we're going to maintain our neutral rating on FCI for the time being. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773, email us at invest@boursefinancial.com, or of course, check out our website at bourseinvestment.com, where all of our research, including this week's article, is absolutely free. And you can catch us in today's business section of the Bigger Better Trinidad Guardian. Have yourselves a great investing week. This has been the Bourse Report.